Welcome everyone to tonight's Hookup with Real Estate Masterclass. We're super excited that you're here. Thank you for joining us. And we have a super special guest, Simon Miller, which we'll be introducing momentarily. First, we have to run a disclaimer. So Ken, would you please share the disclaimer?
Sure. We appreciate you attending the Hookup with Real Estate Masterclass. We are not financial advisors. The content we provide is strictly for educational purposes and not intended as legal, financial, or investment advice, nor is it a solicitation for funds. Remember, participation in this program is at your own discretion. Real estate markets are subject to change and can be dynamic. Hookup with Real Estate and its representatives are not liable for any outcomes resulting from the information provided or engagements with third-party providers. Seek professional advice before making any real estate or investment decisions. By attending, you consent. Somebody just blocked my screen here.
To this event being
This event
recorded.
being recorded, and understand that internet security is not absolute.
Thank you. All right, so we are Hookup with Real Estate. That's Ken. I'm Donna. We empower aspiring and early real estate investors with exceptional education, invaluable skills training, and genuine opportunities to invest in real estate while simultaneously sharing strategies that guide you towards success in real estate and away from costly mistakes. And we made our share of costly mistakes, which are documented in the book, Real Women in Real Estate, which you can find on Amazon, or happy to send you a copy signed. Okay, so Ken is a licensed New Jersey realtor. He's a veteran, also a real estate investor and a tile contractor. If you're in the northern New Jersey area or need a referral, kenneth-hook.weichert.com. Okay, we're also part of Legends Equity Group, with our special guest is as well. And it's a great community, and they offer some wonderful programs like the Legends Breakthrough. And Legends Breakthrough is not a real estate event, but it's a great way to change your mindset. And the upcoming one is January 8th through 10th, 2026 in Las Vegas. And we both hope to be there. And I can share more information about that link. The Legends Real Estate Club has a school community where there's some great information that you can learn at no cost. So it's school, SKOOL.com/real estate club. So these controls are in the way. All right. And we also recommend to invest in tax deeds in Texas, invest.coretaxdeeds.com. They have a very low entry point up until April 5th of next year. So if you want to learn more, just reach out to us. And our calendar, here we are in September. This one and 3 more. Just always like to point out that our November and December master classes are on the 3rd Wednesday instead of 4th to avoid holidays and such. All right, there are 2 ways you can connect with us. We have a YouTube channel at Hookup with Real Estate, and our replays will be there in about a week. And we have a Facebook groups with an S page /Hookup with Real Estate, where we post additional information as well. And if you want to, are looking for more information outside of these master classes, you can take the next step with us by booking a free strategy call. We'll provide real guidance, real strategies, and real investment opportunities. And now we have a quote of the day. Ken, would you please read the
Yes, the
question?
single biggest difference between financial success and financial failure is how well you manage your money. T. Harv Eker.
Thank you. And now we get to the good stuff, which is introducing our special guest, Simon Miller. Now, Simon Miller is a former private banker, professional multifamily investor, and expert in the Southeast market. He specializes in financial analysis, commercial lending, and funding deals. During the last downturn, Simon assisted in private equity transactions, engineering successful acquisition and dispositions of over 2,500 multifamily units over a 3-year period as a consultant. Simon led his company, Dorado Holdings, through the acquisition of a 96-unit and a 106-unit apartment building in Montgomery, Alabama. He's also a decorated military veteran, thank you for your service, and has a Bachelor of Science in Civil Structural Engineer from Georgia Tech and a Master's in Finance and CIS from Georgia State University. He's a beloved husband and father. Please help me welcome Simon as he discusses how to finance a real estate deal. I'm going to stop sharing.
Yay! Thank you.
And spotlight Simon.
All right, everybody. If you need anything, here's my contact info. Let's start with the we have limited time, so what I wanted to cover is go ahead.
First question, though, the very first question
Yes.
we have to ask is, Simon, how did you get involved in real estate?
Wait, can I ask? You said here's your contact info. I didn't see it.
It's in the chat.
It's
in the
Okay,
chat.
thank you.
I would love to have said, you know what, I read Rich Dad Poor Dad one day, and then that smacked me in the head and got me going, but that wasn't the case. It's very, so when my father passed away, it was almost 20, let's see, 24 years ago. So I was thinking I needed to do something. He literally just worked until he got sick. He was one of the most brilliant men I know, but he was from that old school, you know, he was more simple, I guess, thought, and you work hard and, you know, you bring home good paycheck and, you know, you have great family and that's your good life, right? So he was brilliant. He was a, you know, OSHA consultant, and he knew OSHA regulations better than all the, you know, OSHA agents, so to say. But he mostly worked in, you know, textile industry, and you know what happened to textile industry in US. So after that, he had to travel for different manufacturing plant to plant, and one day he's an avid fisherman. He was out fishing in Chesapeake Bay by himself on a boat, and he had a stroke. So he was floating for, you know, I'm thinking, you know, several hours, and until somebody found them and then brought him to hospital, and that's where the saga began. And they found a big brain tumor. So I remember having this vivid conversation with them on my 30th birthday. Before they had, I think that's the last real adult conversation I was able to have with my father. And I didn't get to spend a ton of time with him before because I was working under this moniker of, you know, I need to make it in the corporate world, climb the corporate ladder. When I have more time, more money, I'll get to spend more time with him, right? So that was just kind of my thought. He passed away about 2 years later. So at
Sorry.
one point, I was thinking I needed to do something. Maybe that's when I was kind of disillusioned about, being climbing corporate ladder. I said, I need something different. So it was summer. A friend of mine said, "Hey, there's a Georgia Real Estate Investors Association having this boot camp. Do you want to go?" They're covering all kinds of stuff. So, I knew how to basically spell real estate, right? I mean, I'm a civil engineer, so I know something about that, but I knew nothing about investing other than watching Carlton Sheets on TV, right? So,
No money down.
that's correct. So, ironically, at the time, Georgia had the largest RIA in the country with about 15,000 members. So they were quite active back then. So, I learned about a little bit of everything. I was a little gung ho about it. So I even went out and bought a house on a short sale. I rehabbed it with some referral contractors I had. We had a tenant in there, and then with a traditional, mortgage. And now what? Yeah. So, and then I learned about a lot of concepts. I have a friends in the business, but I hate to say none of it really sunk in. I had a concept, but none of it really sunk in. Um, so this is what I mean by I was a late bloomer. Theoretically, I knew a lot, but I wasn't really applying it. So I suppose sometimes, was it Grant Cardone that said, burn the plan B? So I didn't burn my boat. I had a cushy corporate job still. I was, it was a mid, what was it? Was it mid 2000s? I was making cushy six figures and whatnot until there was a banking crash. So at that point, I could have gotten a job. And then I went to several interviews, and then I was doing some rehabs on the side and everything. So I was like, I can go get a job, but it's gonna put me in this loop, or I better go do something. So I was just coming. It just coincidentally around the time when I saw things happen, right after Countrywide failed, and I got privy to some Countrywide portfolio. I knew a lot about mortgage industry because I was the one who was bundling this mortgage pool to sell to the secondary markets. I was, overlooking like $1 billion warehouse for the bank. That was the pool they were reselling. So at the time, I thought, when they walked me out the door, I'm like, okay, so what am I gonna do? So I can kind of be on this real estate kick, or I can go get a job and keep thinking, the what happened. So in around '07, I mean, so right after that successful rehab, I bought a little bit more ambitious in Roswell, Georgia. It was a nice house with a house with an indoor pool, right? And it's not as glamorous as you think it is, but it just happens that there was a pool they had built and they just enclosed it in a normal house, right? Nice subdivision. Um, Anyway, and bottom fell out toward the end when we finished the house. So we couldn't sell the house. We had an offer to make us maybe break even at the time. So and then I said, like, my partner, one of my best friend at the time, that deal went sour, by the way, later. So we kind of drifted a little. We're still friends, but funny what money does to people, right? So what ended up
Absolutely.
happening? Yeah, what ended up happening, we ended up renting it to subsidize the payment to see if the market turned, but market didn't quite turn. So I found myself at the time I had a business on the side as processing short sales all over the country. So I did a ton of business in New Jersey, as well as I did it in about 7 different states. So I found myself doing short sales on my own property to sell it. We took about $60,000 loss from the deal. So after that, I suppose I was becoming a little bit more, that's when I became more of a consultant to private equity. What I realized at the time was coming off this banking, I had a lot of friends in the industry, and these toxic assets papers were like in demand. So what ended up happening is and then I ended up meeting some commercial brokers from around the country, because there's so many people without jobs, my, Wall Street friends, and say, hey, I know this guy in California, in Florida, and whatever, ended up talking and say, hey, we got a client looking for blah, blah, this and this and this. So, and then just turns out we had access to a lot of banks because we're coming from banking. So we had access to a lot of these toxic assets. So initially, we started to sell a lot of these defaulted papers. And then, of course, in the process of doing it, we had to learn all about, the servicing and everything that goes with the paper sale and origination, and, the what is relevant on the, residential as well as commercial. So that's how I cut my teeth in the paper business.
That's a good lead into
Yeah.
topic you wanted to talk about, right?
Yeah.
Because
so
you did
that's correct.
single family and multifamily.
Okay. So so that's when that's when I got into multifamily business. Some of my paper investors and other investors that popped up, they were looking for bargains. So I ended up somehow point of contact for a lot of these very large brokerages that were coming with all these REOs, because paper business was almost done at the time, and everything turned into REO. So I remember.
Right. So maybe for our aspiring and early real estate investors, you can define paper and REO.
Yeah. Paper is just a loan piece of a promissory note that these different borrowers signed, right? So whether it's a deed or mortgage, if you have a judicial states, those are referred as trust deeds. If you have a non-judicial states, they are just processed as, on the trust states, the judicial states where they are mortgages, and in non-judicial states, they are deed of trust or trust deeds. So basically, it's an instrument that binds your promissory note, to the underlying collateral, right? So just the only difference between judicial and non-judicial state is that judicial states, lenders have to actually sue the borrowers to take the property back to foreclose. Where non-judicial states, all they have to do is just send a notice, right? And they're within the right, and when they foreclose, they get what's called they by right they get the power of a sale deed, and at that point, only difference is how much a right of redemption period that you get. Every state is different. Some states do not even have any right of redemption, and say state of Alabama would have a 1 year right of redemption, right? So that's that difference.
And the right of redemption means that the forecloser could pay and get the property back.
That's correct.
That's my
That's
understanding.
correct.
Yeah, similar to the tax deeds were invested in Texas.
Yeah. So it's the same thing, right? So the you got tax lien and tax deeds, and just because you've got does not mean you own the property just yet, right? So so that's all that means. So anyway, so that's that. And then subsequently, when market started to improve, that's when I got into house flipping. And then some, rentals. I did some short sales, and eventually, I bought my first multifamily property back in 2011. And cut my teeth on Class C property in the rough area. Learned a lot. Almost got my ulcer from it. Had I held on just one more year, I think I would have like made multi six figures more. But I don't really regret having to. I think that deal could have killed me. It was pretty rough, right? So that's where I learned that no matter what you do to your property, you cannot change the submarket, right? So you alone cannot change your submarket, no matter how big the deal is. For instance, somebody sent me a deal today. It was over 900 units. It's in Atlanta, and I actually been to those properties back in the day. And they're blaming, bad management for years, and I know better. I said, it's like some market. It's so easy to point finger at management, but some locations, guess what? It's just not going to run because every property owner will have to get together and decide to change that sub market, which will never happen. So it's a lesson in things. It doesn't matter how good your property looks, what type of marketing you do. If you're a certain grade of tenant, you don't want to be go living in a place where you have to look over your shoulder just to walk out your door to pick up paper.
Yeah.
Or they
We
don't pick up
actually
paper.
just closed on one of those deals today. I mean, sold. So we're like, finally.
Yeah. So anyway, at that point, I mean, of course, we given finance background, it just came normal. I said, you know what, I need to start. So many people ask me advice on loans and things of that nature. I'm like, shoot, why don't I just do financing? Because I distinctly remember back in around it was around 2012, 13 area arena. I have a friend named Joe in New York. I worked on a number of large deals for him. And I remember talking about commercial financing, and it said, "Hey Joe, what about financing this and that, this and that?" And it's like, that's what we have Barbara for. We don't have to know, and she'll handle everything. But I don't like the idea of this black box. I mean, even if you're going to go to somebody to finance a deal, you have to have a good foundation of what you want. Otherwise, they're going to direct you to what they think you want or you should have, or worse yet, they're going to direct you to where those brokers will make the most money, but not necessarily a right product that fits what you need, right?
Right. So maybe you could talk about that a little bit more, like types of products.
Can I ask you a question here, please,
Sure.
Mr. Miller? Okay, so some banks limit their financing to certain areas.
That's
Do you
correct.
have a certain area that you work with, or is it whatever's presented to you, you'll decide based upon its own merits,
So
sir?
short answer is I do financing nationwide. So depending on there's a breakdown is somewhat specific to, okay, sub 2 million and over 2 million. So if it's sub $2 million, it will default to either local banks, brick and mortar banks, Well, for the most part, not national banks, like because City won't finance or Chase won't finance you or little commercial real estate deals. Or you have these secondary market lenders that specializes in smaller commercial financing deals, right?
Yeah.
Large lenders like, hey, we love you, but don't call us for under $5 million. Or, I have a lender that I used to talk to back in the day, and now they gotten big enough. Their points, hey, Simon, our minimum's 15 million at this point, right? So depending on the size, it's different. Number two, under that asset class matters. Certain lenders um, specialize in certain. Actually, let me back out. Certain lenders, yeah, of course, but certain, like for instance, banks like certain deals more than the next, right? So some
Right.
banks will have more like a doctor specialty or private practice or those type of things. They'll be more less stringent on underwriting on certain things like that. So just given, let's say you have five local banks that seems to have similar size, they all have different specialties. One may finance you, one may not finance you, depending on asset class, the location, what type of a loan that you're looking for. So that's all different. And then leverage is even different depending on the asset class. Generally, multifamily will have a higher leverage. Hospitality will have a lower leverage, things of that nature, right? Um,
Right.
and then debt service coverage and those kind of things. So if you're like us looking at say larger multifamily deals, right? The lenders prefer to look at areas where they have done business in, they have certain types of familiarity. Just because they're a lender, that doesn't mean they know every market. So if you're asking for a loan in Topeka, Kansas, some lenders are like, hey, listen, how big is the deal? I'm like, well, it's a $4 million. Well, we really don't want to have to go learn anything about Topeka, Kansas. When are we going to do a loan next? That's a whole lot of effort to just learn a submarket that we've never been in to finance your deal, right? So if it's geographically specific, then it's good to know some local, unless you're in a. That's why I'm getting on a debt marketplace that client of mine built that have all these lenders participating. So I have a further reach where I'll be able to finance just about any deal anywhere without having to, because commercial financing, it always has been more about who you know and your Rolodex. That just to a degree that has been very much true, but in the advent of advanced technology and things of that nature, some of these lenders are participating where they're feeding their lending boxes, their sweet spots in it, where you can kind of fill in some of these criterias and into the system, and then you can get some answers back. So depending on I mean, I'll be happy to talk to you, the offline. But if you have a specific need for certain, happy to answer. But there's so much variations, so you have to be very specific about, even in that example, what type of asset class, what kind of it is. Then I can tell you what the lenders would think about certain deals.
Okay. And do you also, it sounded like you also do commercial, not just residential. Did I
I do
understand that?
mostly commercial,
Okay.
but I have done a lot of residential as well. I just do not do owner occupied homes,
Okay. Thank you, sir.
just investment real estate.
So there's a question in the chat, if you don't mind. Says, do you loan off your own book?
Well, on smaller deals locally, I've syndicated some investors. I have, so like a small hard money type deals. On the larger commercial deals, no, I do not. But I'm getting into a syndicated network where we'll be able to do the loans and things of that nature. So I'm basically being plugged into another network. I can't beat them, so I'm going to have to join them, right?
Yep.
So those type of things, because there's so many different types of lenders out there, right? Um, they you got credit unions, you got REITs, you got the mortgage REIT. You got mortgage REITs and CMBS, and you got the debt, other types of debt funds, and you got government sponsored GSE loans, things of that nature. So in case by case, sometimes some banks do, even some banks do bridge loans. Not all, very some. So you have to know, this is kind of a niche. Certain banks will behave like hard money lenders. So
So do you want to talk a little bit about the difference between single family financing versus commercial
okay,
financing?
for the purpose of discussion, I'm gonna rule out your normal conventional financing, which is basically mostly based on your W-2 or your tax returns, right? That's pretty much universal. Everybody's pretty much the same, right? Uh, Now, difference between having said that, then that leaves your run-of-the-mill hard money loans and then DSCR loans, right, for single family. Um, those are simply they are asset-based loans, but they will have full recourse, matter of speaking. Um, recourse just means that you're personally guaranteeing the loan. They're based on debt service coverage ratio, DSCR. Sometimes they're all referred as DCR, and they will use typically prevailing market rent for the purposes of deciding what the DSCR would be, and the insurance and taxes, right? And then there are certain lenders will allow negative DSCs on some of these residential loans. So typical max leverage is 80%. There are lenders that will even go up to 85% of the purchase. Um, and then typically, for the most part, if it's greater than 1.0 debt service coverage, they will give you a loan. Now there are times, of course, they with a little bit higher rate, they will give you a negative DSC loan, and then and there for short-term rentals, there are lenders that will give you loan and calculate the DSCR based on AirDNA numbers rather than long-term rental rates. So those programs do exist. And for the most part, they don't require tax returns. Just they will check your credit score as a sponsor, but they will loan to your LLCs. So that's for single family residential. Sometimes you can also get a blanket loan, right? Typically, it's referred more than two. Some lenders say minimum five. They will do in, probably no more than like $2-3 million tranches. Sometimes I've seen a little bit larger, and they will group it, give you a blanket loan. They're typically all these DSCR loans are typically 30 years, but there are lenders that'll give you what's called the hybrid, which means it'll give you a fixed period of 5 years, and then it starts floating after that. It'll be an arm after that until end of the term. Or there are some like blanket loans that'll be a balloon after, say, I think 5 or 10 years or something, things of that nature on the blanket products. On the commercial side, it's typically There are certain types of loans that are non-recourse that does not require personal guarantees. There are typically CMBS loans, um, or or your GSE loans, such as Fannie Mae or Freddie Mac loans on multifamily. Now, they will all have what's called the bad boy carve-out clauses, which means if the deal goes bad and they incur losses, and then deal went bad because of your intentional malfeasance, or then they have right to come after you. So then the recourse will kick in at that time. As for different types of commercial loans, you got SBA loans, and you got your traditional bank permanent loans, CMBS loans, also referred as conduit loans. You got bridge loans, construction loans, commercial, the cash out loans. You got private debt, and then you have a multiple of different multifamily loans, different type of product. And they all have different nuances why you would have picked certain debt over next. But since everybody here appears to be very multifamily driven more so than other asset classes, we can kind of go into that a little bit further into that, because as for mechanics of how each things work, they're all about the same. Only difference will be the leverage, meaning that depending on the asset class, as in, for instance, whether it's a shopping center, whether it's a hotel, things of that nature, your leverage LTV will be different depending on the asset class. And then certain qualifying criteria, would be different, right? Because if you do assets like, say, hotel, is not only is a real estate, but it's also a business. So, way they look at that is kind of, different, right? And then when it's shopping center, sometimes they use is this an investment or owner occupied? And typically, owner occupied definition is if you occupy 50% or more of the space. This also applies to office assets, right? Not only the retail assets. So there are a lot of nuances there. As for for the general terms, I mean, the SBA run what typically like is you got 25-year amortization, and you got varying terms. For the most part, they'll give you a floating debt, but there are different types of scenarios where you can get fixed debt on there. Bank debts will run typically 5, 7, 10 years. I mean, there are these mystical 20 type year loans, but I haven't seen that in recent years. As a matter of fact, most banks with the current environment, they will even stay away from 10 years. So you'll be mostly dealing with the 5 to 7 year loans on the banks. And typically the reason you would use them is sometimes their prepayment penalties somewhat light, especially when it comes to, say, credit unions. A lot of credit unions loans do not have they have a very short prepayment penalty period, and they will not have a prepayment penalty. In return, their rates may be slightly higher. So depending on how they decide, the rates are based on index plus margin, right? So typically it's they will price it off of I mean, there's no standardized thing for what the banks. Back in the day, not back in the it's not that too long ago, everybody was using LIBOR. They don't use LIBOR anymore. So they will go index just means underlying standard thing to use, where they can apply some other number on top of it, such as SOFR, right? or 5-year treasury yield, right? 5-year treasury rate. So that would be an index. And they will apply a margin on top of that. So for instance, 5-year treasury rate today is 3.71, right? So if a bank is applying, say, 250, they will, that's just the way they would say it, 250. That means a 250 over 5-year T. That just means that it will become the uh, uh, sorry, I can't do math, isn't mathing. Yeah, that makes 6.25, right? Right. So the incidentally, with some buy downs and everything, incidentally, the best rate you can get in the market right now will be somewhere around there. With some buy downs, you can get into fives right now on some agency loans. So
maybe you could talk about the different kind of buy down, for people not that.
So generally speaking, buy downs work differently depending on who the lender is. On residential side, on a DSCR loans, right? Even then, the lenders would do it differently. Sometimes some lenders will do it. Okay, well, you can buy down the rate maximum up to say 1%, and then say every 20 bibs, which is a 0.2%, is the 1% of the loan amount, something like that, right? And they'll just use these crazy metrics. Or just say, you know what, we have one buy down option. You pay 2 points, and you can buy down 0.75%, right? Every lender with something different. So like you can buy down rates up to like say 0.25% or something like that on Fannie Mae loans right now, which is pretty significant, if you think about it on a payment on a say $15 million loan, right? And that can cost you up to 2 points, right? But over period of if you're holding for say 5-year plus, that might be worth it. Interesting thing about buying down though is that if the loan is calculated based on a DSCR, incidentally it'll end up pushing your loan proceeds up, how much loan you get. So technically you're calculating, okay, well, it's going to cost me 2 points to buy down this loan, but in actuality, that's not 2 extra points you have to come out of pocket to get that loan done, because your loan proceed will be bigger, right? So if you're getting, let's say, a $10 million loan, you may, and then let's say your buy down was, I don't know, $200,000, but you may end up getting, say 10.5 million because of your buy down, then you don't have to come to table with the extra 200. You only have to come to table with 150, right? So the extra 250. So the buy downs work very differently from lender to lender, but and then also depending on time of the year, things are different. And also, by the way, even for the lender, the margin on how they price things change throughout the year. So in the beginning of the year, sometimes they will set a budget or plan of, okay, we want to do this many loans, or in case of say Fannie Mae, they will set out, okay, our projection pipeline, we're allocating this many hundreds, $1 million or $1 billion that for the loan this year. And toward the end of the year, as it gets close, like right now, this is the period, right? When July going into October, they're trying to close out the year. So right now, they're right at the cusp of it. So their rate, their margin right now might actually be a little bit higher, because they want to curve the lending at the moment until they kind of get that visibility into next year's pipeline. Because once the loans come in, start in, say, into October, right, mid-October or later, they're looking at that as a loan for 2026, right? So at that point, their margin may come down, your rate, even if the index stays the same, your loan end up might be being cheaper. So depending on the demand or how many loans they have done up until then, your potential rate's different. So, I mean, this is one of the reason, it's good to have somebody when you're doing financing that kind of knows some of these ins and outs. And also remember that if you're talking directly to a lender, a lot of times regarding a certain underwriting or your situation, a lot of times they cannot unhear what you tell them, right? So yes, they're there to help you, but at some point you cannot come in them just like a friend, because now there's an element of, so are you trying to pull a fast one on me, kind of thing. So you have to kind of be careful what you tell if you're trying to finance it directly with a lender.
Sounds like insurance if you get in a car accident. You can't tell them that you're thinking of putting it into insurance. If you give them the policy number, you're screwed.
Yeah.
Charge you.
So there are a lot of different nuances, different strategies to that, and sometimes when things fail, sometimes some local banks will do some surprising things to get some loan done if they're in a little bit more of an aggressive mode, right? Currently, just most lenders are playing defense right now. They do not like commercial, real estate investors right now. They don't like investment real estate. Their defaults are going through the roof right now.
Is there any specific loan to value that they would, say, yeah, that's a more reasonable request?
No, because what they have done in recent years is that they tweaked it so that they have increased their debt service coverage ratio requirements, DSCR requirements. So what that means is your bottleneck will not be an LTV, but rather your bottleneck will be a DSCR. So a lender could say, hey, we lend up to 80%. Well, guess what? Most of people out there won't qualify for 80% because they can't hit the DSCR, right? That's the hardest thing about the current environment when rates relatively high, especially, things like multifamily, when your typical going in cap rate so close to debt that it's very difficult to hit that service coverage ratio. Now there are some nuances where then you might ask, well, how do we finance that? Well, there are some debt funds where actually they have reduced DSCR requirement, such as like a 1.15, but also, to make that credit work, they will set it as a full-term interest-only loan. So there are some debt funds out there. They might have, say, 3-year, 5-year interest-only loans, but so that's how they're able to lower their the debt service coverage ratio, and they'll be fairly standard. You have to hit that, and we lend up to say 75% of the loan amount, right? So there are programs like that, or some lenders are like, no, we're just not doing maybe first year, but we're just not doing interest only, and the full we will lend you up to this much, but we have to use 20-year amortization or 25-year amortization. So this is how lenders play those defense. If you think about it, technically, the people's, when you have a loan product, right? Let's say they give you a mortgage, say even on your personal homes, if they say, okay, well, you can have a 30-year loan for say, 5.5%, or I can give you a 15-year loan at 5%. Which one would you choose? A lot of people, average people, they look at what they know is interest rate. So they will kind of consider they look at that 15-year loan, but you see what people don't understand is they always have choice to pay down more than whatever 30-year loan payment amount is. So you can still shorten your time of mortgage payoff. But see, if you commit to a 15-year, then you increase your what's called a debt constant. Debt constant means that's what you pay regardless, as a percentage of your loan, right? So if you have a certain debt constant, you're kind of stuck with it, and it doesn't give you flexibility. If you want flexibility of paying less, you don't have such things. So what that effectively did is it shifts the risk from the lender to the borrower by taking shorter term loans. So general rule of thumb for investors when they consider loans, they should so how do I choose what loans to take? Well, first and foremost, one of the things that should be on the back of your mind is choose the loan that has the lowest debt constant, because you always have option to pay more if you need to. But what do you need? I mean, look at all the, real estate investors. What is their issue? They're equity rich and cash poor.
Yep.
Right? So you need to have a lowest debt constant, so that when you have, because sometimes you want to be able to deleverage certain things, right? When the environment gets really, how do you de-risk your portfolio? Well, deleverage. How do you do that? You got to be able to pay down, and that means you need some, liquidity, things of that nature. Again, it comes back to your investor. Choose the deal with the lowest debt constant. But secondarily, when you choose a loan product, is look at what, you start with an exit. So like, which loan do I choose? And like, hey, what are you going to do? What's your plan? When do you plan to exit this deal? Right? So if I go to Fannie Mae loan here, I can get it for like 5.8%, and this bank is telling me 6.7%. Well, guess what? If you get a 7-year deal and you exit at 4 years, then you get 3 years of prepayment penalty or defeasance, or you have to, very, very terrible prepayment penalty you have to pay. So when you kind of add that up, it's pretty significant. Sometimes I've seen prepayment penalty, to the tune of $500,000 or even more. So people don't even think about that. So how some of these investors or operators got in trouble in 2022 is they thought these low rate environment will last forever. So they didn't buy these rate caps, right? So what happened? It kind of shot up on them. So sometimes if you're toward the end of the term where prepayment penalty is little, you want the protection to the upside. when you do the underwriting, you say, you know what, it might make sense to take this loan with a prepayment penalty. I'll just underwrite that fee into the loan as a cost, right? You have to do this type of analysis to get to this granular, analysis to see, because if you're syndicating a deal, then you're a fiduciary. You're not playing with the monopoly money. You're playing with everybody's hard-earned dollar. So you have to look at, all angles. Right. So there are a lot of components that go involved in it, but first and foremost, pick the loan with the lowest loan constant, and two, pick the loan that can coincide with your exit strategy first, and understand that if you have to go longer, then don't go and promise people that, hey, I'm going to be out in 3 years and take 7-year loan, right? So these kind of things. So you want that flexibility. If those things are the key things, then you want to be able to get a longer term loan, but get it from places like credit unions, so you don't run into these type of issues.
Yeah, well, that's sound advice. I know we've done longer debt constant refinances, and the last one we did was a 15-year, but it was at 2.65%. So we just figured get that one.
Yeah, but even at 2.65 and 30-year was, like say 3.2, what really matters in the end is your effective interest, right? It's like taking a hard money, and let's say you borrow $100,000 and your hard money interest is 15%, but you're only going to hold it for 3 months, right? So then what's your effective interest? You're not really paying 15% interest, right? So that's kind of how you look at it. The quicker you pay off, the less interest you're paying. So effective interest will be like, negligible between what you get from a 15-year loan versus 30-year loan if you pay extra, if that was your intent anyway. It just gives you flexibility, not have to pay high payment.
Yeah, no, that makes sense. Maybe in hindsight, 30-year would have been better, but we're just like, all right, we already paid 15 years. Let's just redo another 15. We'll have 30 total. That was our thinking.
It's very easy to get blinded by lower rates. Like, oh, lower rate.
Absolutely, especially with that low interest rate. But anyway, so this is good information, really. So if I was just starting out looking for a lender, though, I mean, besides picking the mortgage, I mean, do I go to a local lender? Do I go to a national lender? Do I go to
are you talking about, like a single family, or
let's just say commercial?
Well, no, commercial deal. I would. So, depending on the size and everything. So if you're looking at like a small commercial deals, I would start with the local lender, just to at least establish a relationship with them. Not when I say local lender, I'm not talking about your local Chase branch, because that's not your local lender, right? And your first bank of something, right? I mean, something community bank, these type of people, right? So the downside is it takes a little bit to build a relationship with them, because once you have a certain relationship, you'll be able to get a credit lines and things of that nature that people don't think about, because you've established certain relationship with them. If you're off the bat, let's say you went to hold on one second, my cat wants out. All right. So if let's say you just went to a somebody's investing boot camp, and just like rah rah rah, it's like, oh, I want to go out and raise money and go buy this deal. So you can typically like choose probably a mortgage broker, somebody who can set up. I mean, you can certainly call me, or anybody. There are different the brokerages out there that serve nationally, um, that make sure that they're not just certain types of. There are certain lenders that they might only do certain types of financing, but generally most like some of the larger brokerages will do all types of financing. So like for instance, Fannie Mae will use a what's called the DUS lenders, which are delegated underwriting and service lenders. So they are basically licensed under Fannie Mae to do the underwriting, and they will also do the servicing on behalf of Fannie Mae, right? If it's a Freddie Mac, then they're under similar thing. They're called the Optigo. And generally speaking, majority of the U.S. lenders will also be in the Optigo network. So they will always be able to quote you Fannie Freddie deals if it's multifamily. But for the most part, the more competent, brokers and whatnot, they should be able to get you a debt quote from, different sources in addition to, what, the one makes sense. Because it depends on what sides of a deal you're going after. You may or may not be able to directly sponsor your own deals, because there is what's called a net worth requirement, right? So let's talk about that. In residential properties, generally there's no net worth requirements. But even in residential, when it goes over $1 million, many lenders will have a net worth requirement. So all that means is, if you're asking for $1 million loan, that means you need to have at least $1 million net worth. And basically, that's what that means, right? So, and if you have it's the same thing. If you have a $10 million loan, then you need to have a sponsor or collective multiple sponsors that add up to more than $10 million in net worth.
They're the key principles on a commercial.
That's correct. Typically, who owns 20% or more of the deal, right? Some lenders will say 19% or more of the deal. So it depends on that, right? And then, of course, we didn't talk about bridge loan at all, but so the bridge loans are a little bit easier to underwrite, but they will go through the same kind of a scenario with the the sponsors. Only difference is some bridge lenders on commercial deals will not necessarily ask for tax returns, right? Some will, some won't. But for all the conventional lenders and the Fannie Freddie lenders will ask for tax returns.
Yeah. Now, some people might not understand what a bridge loan is. Could you explain the difference between bridge and conventional?
Yeah. So bridge loan is a type of loan that's usually fast. Typically have higher leverage for the most part. When I say higher, I mean they'll typically go up to 80% of the purchase if the deal's right. You would have used the loan for one of the two reasons. A, timing, because let's say what happens if a property, you just went and saw a property and the owner's like, you know what, I have to move to, I don't know, Panama in 35 days. If you cannot close in 35 days, then you're not my buyer, right? So, but they're going to give you a spectacular deal. And so I'm going to go down to, First Bank of Donna and get me a loan. And they're like, no, that bank will not give you a loan that quickly. It's, it's not going to happen. So you're going to go to a bridge lender to ask them because you're getting a spectacular deal. And the reason you would do it is so that you would go get the bridge loan and close, and you will immediately go and refinance the deal. Like we talked about, bridge lenders have higher rate. They also will not have a DSCR requirement based on loan going in, but they will also do a forward-looking underwriting. So what they will care about is, A, if I give you a loan now, and will you be able to refinance me out, right? So that's why typically bridge lending will require a value add component. So this is why they say bridge lenders will not take out other bridge lenders for that reason a lot of times. So this is what's happening out there. So
I'm going to try to, is that your dog?
okay.
Sorry.
Secondly, the conventional loans or the other types of Fannie Mae loans, they will only lend money on stabilized properties. Typically out there, what people will say is 90 for 90. That means 90% occupancy for trailing 90 days at the time of sale. But that's not exactly true. That's a good rule of thumb to use. But technically speaking, what the lenders are generally looking for is roughly about 87% economic occupancy. That means 87% of your tenants are paying, right? For 90 days, and just that's general, the rule of thumb or criteria. So if you have really good paying tenants and it had maintained, say, 88% occupancy, and you only had 1% delinquency, it does not mean you can't get permanent loan, because it still would fit. So those things they will overlook and make those kind of exceptions, right? So that's that. So it's a speed, in speed that matters, and then of course they will add in, they will underwrite based on LTV, based on the finished value of the property, right? So once you worked on a property, it's going to worth more, and they will reverse calculate. So of that, assuming that outside lenders will give you 70%, loan to value, can they take us out, right? Those are the type of calculations they would do. And then they look at your pro forma future projections and say, okay, well, based on future projections, assuming, say, certain interest rate, right, can they hit 1.25, and what's the loan amount, will come from there. Then does that cover what we were giving them? So these are what's in the bridge lender's mind, right? So, before, it's just like your investors, a lot of times what's on their mind is not so much a first thought, it's not return on investment, it's about return of investment. Is this investment sound, before you're worrying about, it's going to double my money right now,
Good. Now, if I have too many assets in my name that have leverage on them, is that an issue for some banks, or even if they're covered the rent?
Well, that's more of an issue if you go to conventional financing on the loans. They would look at that, and that would raise your risk factors. But and to a degree, on your brick and mortar banks will look at that, and they will look at the terminology they use, a third party exposure, right? So the real technical term is what's called the contingent liability, right? So that's the term they use for underwriting. But It can, but for the most part, for DSCR lenders, they could care less, right? So that's the short answer. On the commercial financing, the what's more important is that they also have, if you have a like kind property, then they will ask for, the whole type of series of questions regarding its performance, right? So it's one thing to have bunch of deals and then bunch of leverages, but it's another to have you have several deals that are in trouble that you have when you're asking for a loan, right? That's increasing your liability, the exposure for them. So that's when it comes to play. So sometimes this is why you have to do planning for yourself for the future, where the do you don't wait until you need money to go, oh shit, oh crap, oh crap, I need money. I'm in a pickle, kind of thing. So if you wanna, don't get so sucked in where, okay, well, I don't want leverage, to do something, get a HELOC, be able to tap into some of that to some rainy day. It's not always feasible, I understand, but sometimes these type of things can come bite you, because of you have the other loans and they ask you these questions. So your typical institutional route of borrowing money may be blocked at that point.
So we have a question because we're doing a 1031 and the 45-day period starts today, I assume. So at what point do we go and get financing, even if we haven't identified the property completely?
Well, sometimes that's why people do like a reverse 1031 even, right? But the you have to have a general idea of what you wanted to do with your money in the first place before you even, I'm hoping before you even sold what you had, right?
Yeah, we have a
Because
general idea.
yeah, but if you got into a syndication, then you need to find the deal that will, that's prepared for it, right? So they have to turn their deal into a tick, and it's not necessarily cheap. So a lot of times they will not cater to 1031 folks who has less than, a few $100,000 at least, right?
Yeah. Well, we have someone that is willing to cater to the tick, which is a tenant in common.
Yeah, and understand that you're gonna get underwritten by their lender as well when you do that. So there are certain things that you have to kind of, because well, you're gonna have to sign some assignments and things of that nature, and they will do a basic underwriting on you. So you may have to you may not necessarily have to give them tax returns, but you may have to give them some other types of documents. Um, so, but so if you're participating, then you don't have to worry about financing. But if you're gonna do your own deal, then I would suggest doing some planning on based on your asset class. You might have an idea of what type of stuff. You're not gonna have a range of, okay, I can either buy this the single family in Oklahoma City, or buy this, the 50 unit apartment in Miami, you know.
Could be that range, yeah.
That's why it's kind of crucial doing some planning, because what happens in the end is people get a little bit nervous with that timeline and they end up buying something they don't want. So the a lot of times, the kind of a lot of easy default for some of the borrowers that have 1031 money couldn't find anything. They might buy a triple net property, like they might buy a AutoZone or something, and and then do financing on triple net assets. And typically, because of way the interest rates are going and everything, typical leverage on those is like 60% LTV loans, and then you're coming in with the rest with a 1031 money. and they're barely cash flowing based on the debt service, but you have a bunch of equity in it, right? So at least you kick the can down the road, but it just happens. And you also have to be kind of very weary of a type of a triple net assets, because you want to have a long lease period when you sell it yourself as well. But to be fair, they can become decent assets down the road, so long as you don't need cash flow from that 1031 money.
Gotcha. Gotcha. Well, we have about 10 minutes left, so I want to see if anyone on the call has questions. When we continue. So there's got to be somebody.
Yeah, I have a question.
Okay.
In regards to the 1031, now if you were to buy one that is basically a fixer-upper and it's lower than the price that you sold it for, but requires money to bring it up to rehab it, do they take that into consideration, or is it still you have to
I
buy?
don't think so, because it's not concrete.
Yeah, okay.
So you have to, it only applies to the purchase money, not the renovation money.
Okay, that's what I thought, but I figured I'd ask you. Okay, thank you.
Yeah.
I'm going to call on Javier because I know he has a question.
Okay, thank you. Thank you, Donna. Thank you, Ken, for bringing Simon. I really appreciate you guys. So, yeah, I was going to ask a question, but then Simon answered it, kind of. Of course, he really answered it. My brain is the one that takes like little chunks so
Okay.
far. But so my question is this. Let's say that I want to really encourage a lender to give me a $250,000 to buy a triplex, but I'm a subcontractor, and in the taxes there was 4 months where there was not too much income because I wanted to try another business last year. So they asked me for the taxes from last year. So they told me, hey, we cannot qualify you for this, sorry. And when I show them my paychecks, they can see that I can pay the mortgage really well, that the triplex rents really fine. The everything is like it's like a brand new building, very well renovated. People there pays enough to pay by itself, etc., etc. But they say no, the law says that it cannot be. So is there any way that I can
So
encourage them to go ahead?
so that's the kind of curse of conventional financing, because what they're doing is they're using what's called the global debt service coverage ratio based on what's proven, right? So it's not just your paycheck. Your paycheck is just a verification of the income you're making. So it's a VOI, verification of income, and VOE, verification of employment, and VOD, verification of deposits. The it's a Remember, it starts with a V, verification. It doesn't mean that's the number they're going to use for the purposes of their underwriting. So there's no convincing if you have a gap or something, you have a circumstantial thing, it didn't show on the taxes. They're not going to do like forward-looking underwriting based on that. Although, of course, that having it that way will give you the lowest down payment and things of that nature, right? So that's the challenge with the conventional. Um, the uh, the another possibility I kind of project is that, yes, there's a higher financing cost, but sometimes you can go as high as probably like a 90%, 93% of the purchase price plus renovation cost. If you can, especially in current market, you can lowball things. And so if your finished product can appraise for a certain amount, right? Then it gives you that the minimal amount of down payment requirement. And then as soon as you're done, then you can refinance with a debt service coverage ratio loan, DSCR loan. Um, Typically on the refis, the LTV is a little bit lower, but since you're not pulling money out, you're doing just what's called the rate and terms, just taking the original money out. So there are ways to refinance that loan on what you borrowed, so that way technically it costed you original whatever 7% down payment of the purchase amount plus worst case 10% plus some transaction cost. So yes, it's not ideal, but that's the only other way of doing it except for conventional. Because what the lender wants, because there are some alternative types programs, right? There are some conventional lenders that will do what's called bank statement programs, right? So, but the downside to that is your rate's gonna end up being about a whole percent higher. So if you think about it, it'll also increase your, payment, and so you choose your poison. There's no perfect answer for that, actually.
Yeah, but yeah,
Javier,
good
reach out
concept.
to you, Simon, if he
Yeah,
has
he's
specific.
got my number. He knows me well.
Do
Of
that.
course, of course. Thank you so much. Yeah, I really
Yeah.
appreciate it.
Awesome. Anyone else have any questions? Let's see.
Yeah, I got another one.
Okay.
Did you even bother, like, if in regards to like the 1% rule for the multifamily, should you even bother, like, I
I
mean, if
don't
it's like
use.
so out of touch with the 1% rule, should you even bother even looking at ones like that? If it's
I
like,
to be honest,
hmm,
I'm using like a 1.15, 1.2% rule right now when I
okay,
look at deals.
okay,
1% rule does not work on large multifamily.
yeah,
It only works on smaller multifamilies
okay,
because they have lower the lower actually the my 1% rules even more stringent when I do it. I do it monthly. So instead of annual rent, I do I do, or is that the case? 1,000. Yeah, that's right. It's a month. 1% of the monthly rent amount should be 1% of the purchase price. That's the
correct,
typical
yeah,
rule.
hmm,
But so I'm like, so if I'm buying it for say 100,000, it better have like 1,150 or 1,200 in rent, right? So that's kind of way I look at deals. That's assuming it doesn't need much work, and then it goes downhill from there. So if it needs more work, then I'll just discount that even from that.
yeah. So if it's at like 0.75, you wouldn't even bother with it then, right?
No, because
Yeah, yeah,
see
because
the
it's not going to
seller
cover it. Yeah, yeah,
see the seller is in their own delusional mind to ask
yeah,
for whatever
yeah,
they want.
yeah,
But
absolutely.
this is not 2021 or 2022. You need to make an offer that works for you,
Yeah,
right?
absolutely. Yeah,
So and then also there's the price versus terms, right? So you can go into owner financing. Um, there are some other kind of caveats. So what if it's 0.75%, but they're willing to carry you for 15% interest only at 3%,
yeah, yeah, yeah,
right?
yeah.
So it just pick your situation.
Hmm.
So it's not always off. Obviously the owner financing is not as common, but just kind of look at the situation. Sometimes I like to study tax records or mortgage history on the property. if it's free and clear, how I go about how I go about attacking that, right? Sometimes because of that, maybe it's not necessarily getting the deed. Maybe it's about you buy deals on a agreement for deed or land contracts. What people don't know is that once you are into agreement for deed for a whole year, lenders give you credit for the seasoning. So at that point, when you execute on your agreement for deed, well, guess what? You are refining that deal, not a purchase money. So if you got into that deal at good rate with a 10% down, well, guess what? You got 90% financing, and if it's going to appraise for more, then lenders will refinance your rate and terms, right? So I mean, there are other strategies to do skin the cat, and
There's a
sometimes,
cost for that, though.
excuse me,
There's a cost
what do you mean?
to refinance. So if you do a 90% deal
Uh-huh.
and then you're going to refinance, there's still the cost to refinance the property.
I mean, you cannot go to the bathroom just because you don't like the smell of number two. If you gotta go, you gotta go, right?
Okay.
The whole point, I mean, I never said there was no financing cost. If you gotta go, you gotta go. So there's a cost associated with it. So if you have to do a little bit of a cash in financing, then so be it. Or better yet, what if you bought it for $1 million and now it appraises for 1.5? Maybe you don't pull money out, but you get the lender to roll in your closing costs. Then yes, there is a cost, but it didn't cost you out of pocket.
Good point.
Yeah, your tenants are paying for it, right?
That's correct. And then
Hopefully.
yeah, sometimes there are some other strategies that you can use. You can do, because what you get these situations like the owners are like, hey, I'll finance for somebody who puts 30% down or 40% down, right?
Gotcha.
So then it's not a mutually exclusive event. So what you could do is that you could go to a local bank and say, hey, can you give me, say, 50% loan on this? Right? So, and then they say, yeah, you go to the owner, hey, listen, you are going to carry 60% on this, but if I gave you, 50% of the purchase, 60% of the purchase, would you carry 40% in second position? Right? And typically, a lot of lenders will not allow subordination. I mean, because you're thinking like 70% loan to value or whatever. But if you offered a smaller first position to the lender, then it decreases their risk, right? So they will still want to know what your second position is, but because their exposure is smaller, so they might allow subordination by the lender. I mean, the owner. And as far as the owner is concerned, they don't have to carry as much paper in their hand. So they might say, you know what, okay, well, I'll carry 40% instead of 60%. And then now you can just come with a 10% down. So these are very creative owner financing strategies. But when people think owner financing, they think they have to get all the financing from the owner. That's not the case.
All right, we have time for one more question, and I think Armando had it. Armando?
Hey y'all, yeah, I did have a question. I do have a question. Good to be here with you all, and I'll get to it. And so when it came to, the DSCR being accepted at 1%, we always heard for a long time 1.25, 1.2, 1.3, whatever it was. Now I'm trying to think like how are they allowing that to be acceptable? What other criteria is it that they're expecting us to have? Like are we supposed to have a certain amount of reserves also?
That's
Not
correct.
just not just our what you mentioned earlier, our net worth, right? But yeah, our reserves.
Typically, they will require, like depending on the lender, like say 6-month reserve, 9-month reserve, and those type of things. Right. So yes, there are what's called the liquidity requirements in reserves. It doesn't mean it's a collateral. They want to see it. As a matter of fact, just to see that you didn't, go borrow that from your Aunt Sally, they want to see your bank account for last few months.
Okay, for the seasoning.
Carrying a certain amount. Yeah.
Yeah, for that liquidity, because these are for sure when it's at that 1%. Well, I don't even know if DSCR loans are the I'm sorry, I was going to say the unsecured, but they're for sure the secured ones, right? I forgot what the terminology was that you mentioned, but they will be secured. Absolutely right. What was that term?
You're talking about the recourse?
The recourse. Yeah,
Yeah,
there'll be recourse loans, correct?
Yeah, they're all recourse. All the DSCR loans on single family, they're recourse loans. Except the borrower is not you, is your LLC. You're just the guarantor of it, right? So it will not show up on your personal credit, but they will check your personal credit to price the deal, right? But there are liquidity requirements on those. So you gotta, you gotta keep that in mind.
Okay, and you said that was about like 20%.
Liquidity?
Yeah.
Well, a lot of lenders will, some lenders don't, but a lot of lenders will check for liquidity for your down payment amount, like 20%, and then they want to see anywhere between 3 to 6 months of debt service coverage rate, right?
Oh, okay. Yeah. And then the last sub question of that question, if you don't mind, if we're okay, Donna, with time. But the last sub question of that question is, are we also having to show a certain upside to the deal? Like, are we gonna show like we have to show forced appreciations,
on
projections?
the single family?
Well, for commercial multifamily. Well, I'm dealing more with commercial multifamily.
Well, the commercial multifamily, you will always, it doesn't matter who the lender is, you have to do a pro forma, right? And then the pro forma, as for, and that's your just the future, that's your future assumption. But in terms of the values, typically no, because what they're going to do is they're going to pull their own comps and make their own decisions based on that. So typically how they size that up is not so much because nobody knows future, right? But what they can do is check your pro forma and look at your assumptions. If you say, hey, I'm buying a 200-unit apartment, but I'm going to run it at 30% expense ratio in the future, they're going to say you're crazy. Your numbers go out of whack, right?
Yeah, for sure.
But even if you have pretty close, but all the lenders will have their own guidelines on preset. You might say, okay, well, I can run this much on the maintenance. Well, they might have their own maintenance factor, so they're going to overlay that over your number. So your number might be heavier than theirs or lower than theirs. It just depends, right? So based on that, based on the final net operating income in the future, they're going to do an assumption of a backing out. Okay, well, based on that, what will give you 1.25 DSCR, and what's the loan amount based on that, based on the future yield curve, right? So based on that, they said, okay, well, that will be enough to take us out, therefore, here's the loan amount. So rather than using the property value, they look at more of a DSCR. But like I said earlier, that the bottleneck right now is DSCR, not the LTVs.
Yeah, absolutely. And I finally wrapped my head around that too with, at that point, if we're at 1 and we want to be safer with that higher DSCR,
I get that question a lot. A lot of people say, what LTV loan can you give me? I said, LTV is the least of your problem.
Yeah, it makes complete sense for sure. But I was thinking they had like a requirement that we had to show them that we were under market rents and by a certain threshold, to meet that 1%. DSCR, before they were always wanting us to be at the
Because they-
1.25 DSCR, but since interest rates are where they're at, they were saying, well, that
Yeah,
whole.
but they're gonna check your pro forma because you're gonna have your rent assumptions, and then they're gonna have their appraiser, and then they're like a system to check the prevailing market rent and your rent escalations to see if that make any sense, right? So they're gonna back
Yes,
that
sir.
out. Yeah.
We have to kind of wrap it up here,
Yeah.
but
Yeah, thank you.
Simon,
Thank
if you would put your contact information in the chat again, there were some people that came later and may not have it. I'm going to remove the pin on you.
I'll make sure I put a timer on next time, Donna. I only get
No,
1
no,
minute.
no. It was a great question.
Yeah.
We
Appreciate you.
definitely appreciate it.
Sorry.
It's just we have to be respectful of everyone's time.
Hopefully that was useful information for
Oh,
everybody.
very useful, very useful. A lot of
Absolutely.
golden nuggets in there.
And very informative. And congratulations to your Yellow Jackets football team, 4-0.
Oh yeah, they're the unexpected. I'll take it.
All right, Don and Kenny, thank you. It's dinner time over here. You take care. Love you
All
guys.
right. Thank
All right.
you. And
Thank
thank you everyone who attended tonight's call. We really appreciate it. This replay will be up on our Hook Up with Real Estate YouTube channel within about a week. And I'll send out the recording as well. So thank you again so much, Simon. It was a great call. Really appreciate your time and your expertise.
Guys.
Thank you, Donna and
Thank
Ken,
you.
for hosting this.
Thank you.
All right.
Great job.
Good night, everybody.
you.
Good night.